Maverick Traders, welcome back to your class series, and today we're going to look at mergers and specifically looking at trading them through arbitrage and what the ideas or concepts would be there. As always, we want to remind you that everything we go through is intended to be educational. We're going to be talking about some mergers, but this is not a suggestion that you should go out and trade them. So the first thing you need to know when a merger is going through is it a cash deal? Sometimes it's a stock deal. Sometimes it's part stock, part cash. You need to know the specifics of it if you're going to trade it. Now, cash deals are the easiest. Activision being acquired by Microsoft. That is an all-cash offering. The deal price is supposed to be struck at 95. So if the deal closes, all Activision shareholders will receive $95 per share and be out of their shares, and Microsoft will own the entire company. They're being bought out. Even if you voted against it, the majority have ruled. They said we're willing to be acquired at 95, so your shares are going to be sold out from under you. Sometimes there's a stock deal. Sometimes it's a cash and stock, like VMware is being acquired, but VMware is being acquired by Broadcom in a cash and stock deal. So there's the problem with that. There's pros and cons, basically. VMware shareholders are going to receive a certain amount of cash and a certain amount of shares of Broadcom. So they're going to receive, and it's, X amount. So let's say, I'm just making this up, but let's say it's $50 in cash plus, 0.20 shares of Broadcom or something. You would basically have to calculate what the deal is going for and say, okay, well, at current share price times 0.2, that equals this plus this, and you'd have to kind of figure that out. And those get a little bit more complicated because the deal price is fluctuating to a certain extent, right? And so there's maybe more upside, more downside, more risk, probably more risk to the deal falling apart and so forth, where this one is the easy one. And usually if you're going to try to trade a merger arbitrage situation, you kind of like the fact that that's set in stone. Now, the deal can easily fall apart, and the Microsoft Activision deal is already, a little bit tepid. I mean, you can see the FTC is suing to block this acquisition. Other games makers, so I think Take-Two, maybe Electronic Arts, some of those others have just started to sue Microsoft basically and trying to stop this deal. So there's a number of different things happening trying to block this. And that's why Activision right now is trading at like $75 per share, even though the deal price is supposed to be at 95. Now there's a lot of problems and a lot of issues between this deal closing, and they're hoping to close it by June of 2023, which is in about a half a year, but there's no guarantee to that. This might be tied up in some courts and so on and so forth. So what is merger arbitrage? Well, the most simplified way to do it is just through stock, where you say, if I really, really feel confident this is going to go through and it's going to be closed by June. Now, if this passes, and kind of goes on its way, it might close before June. That's just their goal. They might close this deal up in May, right? And that fast forwards any options you're trading. Expiration gets fast forwarded to whatever the deal closing price date is. So if you're trading the stock, whenever it closes, you're going to receive 95. So you'd hope that it closes sooner rather than later. You want your money and your capital freed up as soon as possible. This deal could drag on. It could go to September, October. It could do all sorts of things because we just don't know what's going to happen with the litigation and getting it tied up in courts and so on and so forth. But assuming it closes in June, you'd say, well, I have an easy $20 profit. I'm going to make $20 per share because I'm confident it's going to close, and I can buy the shares today at 75. That's a 26.6% return on investment, in 6 months' time, okay, I'll go for that, right? So if we're confident the deal is going to go through and we're confident that it will close by June, it's a pretty nice opportunity in the stock. So that's the first merger arbitrage is you know where your sell price is, your buy price is as low as you can get it right now, and you profit the difference. If the market was confident this deal was going to go through, these shares would be trading at least in the 80s. Let's say it was trading at 88. Why doesn't it trade to 95? Well, nobody's going to buy at 95 if they are guaranteed to sell at 95, right? So you have to have some profit to potential to attract buyers. The more confident the deal is going to go through, the higher it'll trade and the less profit you have to arbitrage out. But let's say it's trading at 88. Now you only have $7 of upside versus your $88 share price entry. Now it's only 7.9%. That would imply the market is somewhat telling you their level of confidence. If there's a lot of arbitrage, a big margin there of profit, well, the market's deeply concerned, let's say. If there's very small amounts of profit, the market's more confident it's going to go through. So this Activision Microsoft is a very interesting situation because there's a lot of profit there, but there are a lot of hurdles that we need to jump over before we get there. Next, let's talk about option market and how to play this. Here's the biggest issue. There's just not a lot of volume and open interest and not a lot of traders doing anything with this. Now, part of the reason is because we need to go out in time. We need to go out a long ways because we need to be past June. If they expect the deal hopefully to close in June, what if our option trade closes out early and so the stock never got to 95 and so on? We know where our target can be. 95 is the obvious target. If we're bullish and we want to exploit this arbitrage in the options market, we know what option strike price we're selling. Probably selling that 95 strike call in some capacity, right? We're happy to make a promise to sell at 95 because that's where the shares are going to be sold anyway. So the likelihood it trades well above 95 is very, very low. Basically, the only way that happens is if the deal falls apart and some reason Activision skyrockets, unlikely, or there's another buyer that steps in. Again, probably not all that likely at this point. So selling the 95 call is great, but again, there's not a lot of liquidity in this, and this is the big problem. It's just a headache to trade these because you've got a mountain of difference between the buyer and the seller. 27 to 60, that doesn't sound like that much, but compare that. Let's say this was a real estate transaction and you were looking at a $270,000 home on the buy and the seller's asking $600,000. That's what it basically is equivalent to. The buyer and the seller are so far apart. On a percentage basis, the difference between 27 cents and 60 cents is, 33 cents on an option is probably worth somewhere around 40. They're like 100% apart, almost. So that's a big headache. Now, that's the option we're selling. Now, we can use limit orders, and of course, we would do this as a spread. Next, we have to consider which option we're buying. And I think it makes sense to buy out of the money. The deal closing or not, I don't want to spend a ton of premium on this. And the more you spend, the bigger the overall return if the deal goes through, but the bigger the risk. So let's consider. We could buy any of these against selling the 95, okay? All I'm building is a bull call debit spread, right? Where the option we're selling is at the deal striking price of 95. That makes sense to sell that call. But which call do we buy? Well, let's build a few of them. Let's say first how much we're going to collect for the 95 call. And if we split the bid-ask spread and kind of give a little bit of ground, we can probably get filled selling that option for maybe 40 cents. Let's hope that we can at least collect 40 cents per contract on that. And somebody says, well, why even sell that for $40 per contract? Well, it's going to come in handy. It's going to have a reduction of total cost. And we're okay selling it because there's very little upside above 95. So why not get that $40 back, right? Now, the option we buy, let's start with a lower cost, lower risk. Let's say we buy the 85 call. I think it's far from a sure thing you're going to get filled on this trade, but hypothetically, we should be able to get filled on buying that option somewhere in the $3 and something range. If the buyer's at 230 and the seller's at 450, the difference between those two is very wide, right? If we say 450 minus 229, the difference between them is $2.21. Half of that, if we split the bid-ask spread, is about $1.10. So, I mean, realistically, this should probably be going for, well, let's say 229 plus 110 would put us at about 339, 340. So, again, I don't know that it's a certainty you're going to get filled on this, but hypothetically, you could buy the 85 call, sell the 95 call, and maybe you have an outlay of $3 debit. My guess is you're probably going to have to pay more than that. You'll probably end up paying $3.50. I mean, they're a headache to trade, okay? But let's make it even more realistic. Let's say we got to get bad executions. That's just the nature of bad liquidity. Let's make it more realistic. Let's say $3.50. We have to pay too much or collect too little for that. That's probably more realistic, frankly. I've traded these before, and you've got to work your limit order, and it's got to sit out there for a long time, and it's got to attract someone on the other side, and there's just no one else trading it, and so you have to sacrifice price if you want it, and you just end up with a kind of a lousy execution price compared to something that's heavily traded and liquid. So that might already turn a lot of you off, and you say, well, I'm not going to waste my time screwing around with these. But it can kind of make sense, because if this deal goes through, look, we're going to sell, the shares are going to be sold at 95. We're getting out at 95. We got to buy at 85. We made $10 minus 350 cost. Hey, $650 of reward for $350 cost and risk. Maybe it's worth a little of our effort, right? So that's one scenario. Risk $350, make $650. It's kind of a 2-to-1. Again, no guarantee we can get filled at $350 even. I mean, this might cost us $4. It might be $4 to $6. It's just, I just emphasize how bad the liquidity is in these. Next, let's say, well, what if we did one that was more aggressive? Like we could buy the 80 calls. Now those are going to go for probably closer to $6, maybe even $6.50 or something. We're going to probably have to pay a hefty price, but let's say we pay $6 for the 80 call. We know we're collecting around 40 cents for the 95. So our net debit here and max risk in this trade is $560. $560 is your risk. But what's our reward? Well, now we've got a 15-point spread. This one was 10 points. 10 minus 350 gave us our reward. Now we're at 15 points wide. Now we're trading these two, right? So we have $15 of profit minus our 560 cost. Now we've got 940 of potential reward. Now these are a smart arbitrage because A, we're going beyond when the deal is expected to close. B, we are trading bullish and targeting the deal price, and it's an all-cash offering. And C, we've got high reward compared to risk in the neighborhood of 2-to-1. Does this make sense? Well, this certainly makes sense if you think the probability of this deal going through is 50% or greater. If you think there is a greater than 50% chance that this deal closes, these strategies get it done, right? If you think that there is a 10% chance the deal goes through, well, you're not going to take these trades. So part of it is getting the actual merger to go through and being right about that. I think that these can be more effective and less risky than the stock, just given the potential downside. If the deal falls apart, it's certainly possible that this stock could fall $20, $30 per share. I don't know that it would fall that far, but it's possible. So you're talking about a lot of risk in the stock. If this deal falls apart, in the options market, we're risking considerably less than that, right? The aggressive one was 560 bucks, the less aggressive was 350 bucks a risk, some sort of bull call spread. Now the last idea would be to go maybe call butterfly. And the reason you might do that is you'd say, well, if I'm certainly confident it's not going above 95, I might as well sell extras of them, right? What if we buy the 80 call, sell 2 of the 95 calls, and then, complete the butterfly? You could do it broken wing, but that would leave something naked, buy that one. So a butterfly, you do 1 of the wings and you sell 2 of the body. All it's doing is it's still this bull call spread, essentially, but it's adding this bear call spread on top of it that might pay you not 40 cents, because you have to pay a little for this, but it might pay you an extra 20, 25, 30 cents, something a little extra, so that instead of 560 risk, now you're down to 530, 535. It reduces your risk, it increases your reward. Assuming you're never going to trade above 95 through August, you might as well. You might as well pick up a little bit extra credit, and you'll get a reduction of risk and an increase of reward. And again, if the deal goes through at 95, this butterfly lands perfectly and settles perfectly at 15 points, and you get better numbers. Maybe, now you're at 530 risk, which means your reward is 970. It's not a huge difference, but I could see something like that making sense given the fact that, again, the deal is going to go through at this price if it goes through. And if it does go through, you might as well have stacked extra and got a little extra credit and got a little bit better numbers and things that way. Now, by adding additional strikes, again, you're just dealing with less liquidity. Let me say that never, ever, ever would you want to try to leg in. Don't try to leg in on these where you're trying to buy this one first and sell this one a few minutes later, or buy this one first and sell these later and then try to buy. There's just such a lack of liquidity. Trade it as a package deal. Make sure that you get your price or better, or we simply pass on the trade. And that's a way to trade merger arbitrage. When they talk about merger arbitrage, obviously stock, very simple. I buy today, I expect the deal to close, I make the difference if that happens. With options, it's a little bit more complicated. The lack of liquidity is always what's the bigger issue. The wide bid-ask spreads. If Activision was not going through a deal, a buyout, these bid-ask spreads would be tighter together and so on. But as such, there's just less interest in these. It just becomes more difficult for people to get executions. So I hope you enjoyed this class and learned some new things about merger arbitrage. Everybody have a safe and happy holiday. On behalf of Maverick Trading, I'm Corey Halliday, and we'll see you next time. Goodbye, everyone.